Good morning. Thank you all for joining us today for our free webinar, Strategies to Optimize Social Security Benefits. For those of you joining us for the first time, my name is Amanda Sylvia. Some of you may know me more recently as Amanda Murray, but I recently just got married. I am the Client Service Associate for Stonehearth Capital Management, and I've been with the firm for about 3.5 years. My primary role includes client service, marketing, and compliance. I'd like to start off with just a few housekeeping items before we get started. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all the questions and will ask David to answer as many as time allows at the end of the webinar. If we do run low on time and we're unable to get to your question, David or I will reach out to you directly after the webinar to make sure we get your question answered. Now I would like to introduce our speaker for today. David Juliano is a Senior Financial Advisor at STM. David joined our firm back in 2016, bringing with him over 20 years of experience in financial planning and wealth management. David began his career after graduating from St. Michael's College and working for a financial advisory practice that specialized in executive benefit solutions and deferred compensation plans. He then went on to spend 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with a complex financial planning solutions and building comprehensive wealth management plans for clients. David has extensive expertise in Social Security and has a lot to share with us all today. David, thank you so much for joining us.
Amanda, thank you very much, and congratulations once again on your wedding. It was a fantastic time, by the way. And good morning to everybody else, and thank you for joining me today. As Amanda mentioned, I am David Juliano, Senior Financial Advisor with Stonehearth Capital Management, and very pleased to have all of you with me today to talk about Social Security benefits. It's a topic that I have studied a lot over the years, and maybe get a little bit too excited about, but it is a topic that a lot of people ask about, and a lot of our clients ask questions about this topic. And we do spend a lot of time with our clients planning around this topic because it does end up being an important part of one's retirement income. And for many people, there's been a notion of Social Security benefits not really providing much in their retirement in terms of income, or maybe some articles that have been out there about the Social Security system going broke and all those things. But I do think that the Social Security benefit does remain an important foundation in one's retirement income, and it's important to do a lot of planning around that. So at Stonehearth, we do like to spend time with our clients talking about it, and I do think it's an important topic to keep current with, because there is from time to time changes in the rules that affect almost everybody, and I'm going to get into some of those things as we move through our webinar today. So again, thank you for joining us, and we will have some time at the end for questions. So let's start with just talking about how one would qualify for benefits. And the way that it works is you need 40 work credits are needed for to be able to qualify for benefits. And the way that it works is you can earn a maximum of 4 credits per year. And the way that a credit is earned is you need, in 2018, you need at least $1,320 of covered earnings to earn 1 credit. So sometimes credits are earned over the year, 1 per quarter, or it's possible that in 2018, with that $1,320 limit to earn 1 credit, as soon as you earn enough money or $5,280 in a year, then that will get you the ability to earn the 4 credits. So naturally, with the ability to earn a maximum of 4 credits per year and the need for 40 total credits to be eligible for benefits, one can be eligible over a minimum of at least 10 years of work that you paid into the system. So now that we know how you qualify for benefits, an important part of this whole idea around what your benefits are going to be is having a little bit of an idea of how your benefits are calculated. And the way that the system does this is they take the average of the 35 highest earning years of work. So the dollar amount of your Social Security benefit is based on your lifetime earnings. And your actual earnings are adjusted, or what we would refer to as being indexed, to account for a change in average wages since the year the earnings were actually earned. And the size of your benefit in retirement depends on how much you earned during your working life. And the system keeps a record of how much you made every year up to a ceiling. So in 2018, that ceiling, or what sometimes is referred to as the Social Security wage base, is $128,400 in 2018. So for any money that someone earns above that in 2018, that you don't pay Social Security taxes on those earnings, and therefore it's not calculated into your overall benefit formula. So what the system does is they calculate your average index monthly earnings during the 35 years in which you earn the most, and it applies a formula to these earnings to arrive at what's your basic benefit, or what's referred to commonly as your primary insurance amount, or your PIA. And this is how much you would receive at your full retirement age, and we'll get into what that age is in a moment. And that depends on your date of birth. So finally, then the age at which you claim your benefit will determine what your monthly payment is. So a lot of times many people will say, well, what if I didn't work 35 years? So the system will always use 35 years. So for example, someone who had 30 years of working history, the system will actually use 5 years of zero earnings in there to always use 35 years. So those 35 years are going to sometimes have a dollar value in there, or if you didn't work 35 years, then it would have zeros in the calculation. And if you have more than 35 years, or sometimes people will say, well, as I work later in my career, what if I start to work part-time, and will I actually impact negatively my benefit? And the answer is, well, it depends. So sometimes that year of work later in life where you reduce hours or you're working part-time, those earnings might still be higher than a year that you worked many, many years ago, and it might still bump out a lower earning year and be part of that highest 35. So it really just depends on what those earnings are and whether it's going to be part of those highest 35 years. Now, I mentioned full retirement age and how it depends on your year of birth. So as you can see, right now, commonly for most people, the full retirement age is 66. That's for people born between the years of 1943 and 1954. But it's important to note, as you see on this table here, that beginning with the birth year of 1955 up through 1959, the full retirement age increases by 2 months for each year of birth, beginning with 1955. And then for people born in 1960 or later, the full retirement age goes to age 67. And basically what you can see on the third column of this table is the assumption here is that a person's primary insurance amount, which I mentioned in the last slide, that's the amount of monthly benefit you would receive at your full retirement age. This table assumes that primary insurance amount is $1,000 per month. So you can see for someone with a full retirement age of 66, if they were to claim their benefit at 62, which is 4 years early, then their percent reduction is shown in that far right column. It would be a 25% reduction, and therefore their benefit would be $750 a month. So you can see the sliding scale as you move down in that table. For someone born in 1960 or later that has a full retirement age of 67, you'd still be eligible to claim a benefit at age 62. That's the earliest you can claim a benefit. But now you're claiming 5 years earlier than your full retirement age if you're born 1960 or later. So now your benefit's reduced by 30%, and you would receive $700 a month instead of $1,000 a month if you had waited till your full retirement age. So the idea is that you're basically penalized or your benefit is reduced by claiming early. And the formula is actually such that it's calculated for every month that you claim early. So it's not as if you're about to have a birthday, well, gee, should I wait? And I was going to claim at 63, but I'm 62 in 10 months. Should I wait a couple of months? And it really doesn't matter that much. The benefit formula is such that it's a calculation based on each month that you claim early. So it will have an impact if you claim 1 month or 2 months before your next birthday, but it's not as if you have to wait till that next year to receive a certain benefit calculated based on just reaching that year of birth. It's done by month. So I talked about how when you claim matters. So at age 62, that's the earliest that you can claim a benefit. And as we just saw on the last slide, the benefit's reduced anywhere from 25 to 30%. And it is a permanent reduction. So we spend a lot of time talking to people about this is why this decision on when to claim is important, because it's a permanent reduction in your benefit. So we saw on the last slide, if you were going to get $1,000 a month and you claimed at 62 and your full retirement age was 66, that's 4 years early, you'd receive $750 a month. And that's a permanent reduction in your benefit. Now, Social Security benefits do increase, are eligible to increase each year with inflation. So you might get a little bit of a bump up, but the idea is that percentage reduction is permanent and it stays with you for your lifetime. So the next area to think about is full retirement age, and that's the age at which you would receive 100% of your calculated benefit, or again, that primary insurance amount that was based on your 35 highest years of earnings. And as we saw, that age 66 is full retirement for those born between 1943 and 54, and it starts to kind of creep up from there. So it's important for those folks who are reaching their full retirement age now, this idea of it being just 66 is that's going to start to change for people. So it's going to start to be 66 in 2 months and then 4 months and so on. And then, of course, if you wait and claim your benefit after full retirement age, then you can get a little bit of a benefit increase. So just like claiming early decreases your benefit, if you can afford to wait even longer after your full retirement age, your benefit will increase by 8% a year every year until age 70, and at which time your Social Security benefit maxes out at age 70. So there's no real practical reason to wait beyond age 70. But from your full retirement age to age 70, you do get an 8% per year bump up. So if you wait till age 70, your benefit would be 32% higher than it would have been at age 66 if that was your full retirement age. So going back to that slide before where your benefit would have been $1,000 a month at age 66, it would be $1,320 a month at age 70. So it can really have an impact if you're able to wait and get those delayed retirement credits of 8% per year after your full retirement age. So in sticking with this theme of reduced and increased benefits, let's just take another look at what that means. So on this slide, if you kind of focused on the middle bar, which has the $1,000 mark at the top of it, and you can see at the bottom, it shows the various ages. So let's again assume at age 66 you would receive $1,000 a month. You can see the bars to the left of that age 66 show what it looks like to get reduced by claiming early. So we said, well, if you claim at 62, you'd get $750 a month. But you can see what it looks like by claiming at 63, 64, 65. So it's generally around a 6 to 7% decrease or penalty per year by claiming early. Now, if you look at the bars to the right of the age 66 bar, the math is a little bit cleaner because, as I said, it's a simple 8% increase each year. So you can see if you were going to get $1,000 a month at age 66, 8% of that would be another $80 a month. So you can see it goes from 1,000 to 1,080. 1,160, 1,240, all the way up to the 1,320 that I mentioned is that would be where it maxes out at age 70. So again, this is an example based on if your benefit was $1,000 a month. So it's nice to just kind of see how that early claiming can penalize you, or how that delayed claiming can help you from year to year. So that's a summary of what it looks like to claim your own benefit, and whether you claim it early or you wait and claim it after your full retirement age. So as we all know, other folks are eligible to receive benefits off of any worker's benefit. So way back when these benefits started, they thought it was a good idea to also have a spousal benefit based on that primary worker's benefit, as a way to allow maybe a non-working spouse who would not have otherwise qualified for their own benefits, allow that person to receive a benefit off of the worker who has been eligible to claim a benefit. So the way that the spousal benefit works is, to be eligible, you have to be 62 or older, and the worker spouse must actually be currently collecting their own benefit. And the spouse must be legally married to the worker that has claimed their benefit at the time that they apply for their spousal benefit. And they must have been married for at least one continuous year prior to applying for that spousal benefit. So that's how you are eligible for a spousal benefit. Now let's talk about, what does that benefit look like? How much does a spouse get as a percentage of that worker's benefit? Well, the way that the rules work is, a spouse would be eligible to receive up to 50% of the spouse's full retirement age benefit. But that's only if the spouse begins their spousal benefit at their own full retirement age. So just as a worker's benefit would be reduced if they claimed early, a spouse's benefit can be reduced if they themselves, the spouse, claims early. So the way that would work is, the spousal benefit could be 35% of the worker's benefit if that spouse claimed at age 62. Or if they claimed at age 65 and their full retirement age was 66, they'd have a slight reduction off of that 50%, and it would be about 45.8%. So it's important to know that even if the worker waited till their full retirement age and they're receiving their full benefit, if the spouse claims the spousal benefit early, they're going to be penalized. So let's just run with that example of $1,000 a month that the worker was getting. If keeping it real simple, if the worker waited till full retirement age and they claimed benefits at age 66 and they got their $1,000 a month, and the spouse happened to be near the same age, and the spouse waits till 66 and says, hey, I don't have my own benefit, but I'd like to get my spousal benefit. So in that case, if the spouse themselves was full retirement age, they would get $500 a month, and it'd be a total of $1,500 a month coming into the household. But if that spouse was younger and they were 62 and now eligible to get a spousal benefit, and they wanted to start at that time, the worker would be getting their $1,000 a month, and if the spouse claimed the spousal benefit at 62, they would get $350 a month. Now, there is a little bit of a quirky scenario where a spouse can actually be getting greater than a 50% benefit, and that's a situation where, let's say, the worker was going to be eligible to receive $1,000 a month at their full retirement age, but the worker claims at their earliest age at 62. And again, with the numbers we've been using, that let's say that worker claims at 62 and now they're receiving $750 a month because they were reduced by 25%. But the spouse is a little bit older. Now the spouse has had to wait for the worker to claim their benefit to enable to trigger the availability of the spousal benefit. But let's say in this case the spouse was older and that spouse was already age 66, so they reached their full retirement age. If that spouse then claims the spousal benefit at their own full retirement age, then they would get 50% of the worker's full retirement benefit. So in this case, that spouse would get 50% of 1,000 or 500, while the worker had claimed early and was receiving 750. So in that case, the spouse would actually be receiving a greater than 50% of what the spouse was actually getting. So there are times where you actually see that happen. So those are some ideas around the spousal benefit. Divorced spouses can also claim a benefit as well, but the rules are slightly different. So let's take a look at what that means for an ex-spousal benefit. In order to be eligible for that, you had to be married to the worker for at least 10 years, and you would have had to be divorced for at least 2 years, and you have to be, again, at least 62 years old, which is the starting point for all regular and spousal benefits, and you have had not to have been remarried. And to claim the benefits off of that ex-spouse, you would not to have been eligible for a equal or higher benefit on your own record or someone else's record. So basically, you are able to claim benefits as an ex-spouse, but if your own benefit is higher, then you're going to end up receiving your own benefit. Now, the key part here is, I mentioned a moment ago with a married spouse's benefit, I said the worker actually has to have claimed their own benefit and be receiving it for the married spouse to be eligible to get their spousal benefit. The rules are slightly different for ex-spouses. So the worker whose benefit the payment is based off of, they don't have to have claimed their benefit. They just have to be at least age 62. So let's take the example of two ex-spouses. They're both age 62. The worker has not claimed their benefit yet. They're still working. They're not interested in claiming their benefit, but their ex-spouse wants to start their ex-spousal benefit. Well, the worker does not have to have claimed their benefit, but because they've reached the age at which they're eligible to claim a benefit, now that ex-spouse can raise their hand and say, okay, I'd like to claim my spousal benefit off of my ex-spouse's working record. And the same idea applies that we just talked about related to reduced benefits for claiming early. All of those same rules apply for ex-spouses who claim a benefit. Now, there's another benefit that's paid out to survivors of a worker who was eligible to receive benefits. So it's important to remember that the spousal benefit and the survivor benefit are two different buckets of money. So there are some different rules that come into play here. So with a survivor benefit, a surviving spouse can receive a benefit beginning at age 60. So remember, that's a little bit earlier than what the age is to claim your own benefit or a spousal benefit. So the survivor benefit can begin as early as age 60. And in this case, it equals 100% of the deceased worker's benefit when the survivor claims at their own full retirement age. And if a reduced benefit was being paid to the worker who passed away, then the survivor benefit is based on that reduced amount. And as I mentioned, if the survivor themselves is going to claim prior to their own full retirement age, then that survivor benefit is reduced. And since you can start to claim as early as age 60, if you claimed at that point, you'd get about 71.5% of what the decedent's benefit was, up to about 99% in the year before your full retirement age. And if the survivor waits till their full retirement age, then, as I said, they'll get 100% of the deceased worker's benefit. And an important note here is that if that deceased worker had waited and claimed their benefits after their full retirement age, and they were getting any amount of those delayed retirement credits that I talked about, the survivor would also receive that delayed retirement credit, or up to 100% of what the deceased worker was getting. So a lot of times in our planning, we talk about situations where maybe a higher earning spouse may want to wait as long as they can to receive their benefit, since that higher earning spouse would be getting a higher monthly benefit. If the lower earning spouse were to predecease, then that higher earning spouse's Social Security benefit really continues for 2 lifetimes, for their own and then that of their surviving spouse. So if it fits with the overall financial plan, then it can be very beneficial for that higher earning spouse to wait as long as possible, because their own benefit may end up being paid out to not only their own lifetime, but the life of their surviving spouse as well. So important to analyze that when you're looking at your own financial plan and the landscape of all the retirement income sources that a family has. So a little bit more on the survivor benefit. In order to get that, you must have been married 9 months prior to the worker's death in order to qualify. And you would collect your own benefit if it was higher, or switch over to the survivor benefit if that was higher, but you can't collect both. So if 2 spouses were collecting benefits and one spouse passes away, that surviving spouse would end up just staying with their own benefit if their own benefit was higher, or they could switch over to the worker's benefit if the worker's benefit was higher. But in that case, one of the benefits, the lower one, will drop off. You can't collect both. And the survivor benefit can be claimed independently of one's own benefits. So if a spouse passes away and the survivor has not collected their own benefit yet, one strategy that we look at sometimes is for that surviving spouse to elect to claim the survivor benefit for a while, and if they qualify for their own benefit because they've worked over their lifetime, if they have their own benefit, they can actually delay collecting their own benefit maybe up to age 70, let their own benefit max out at age 70 and be 32% higher than their full retirement credit. They can collect the survivor benefit all throughout that period, and then at age 70, they can switch over to their own benefit, and it would have been maxed out at that age 70. So it's an important element to look at, again, with the whole landscape of your retirement income, to see where that strategy would come into play, where it might make sense to delay your own benefit and start with the survivor benefit. Now, others can receive benefits as well. So a surviving spouse, even if they're younger than age 60, they can receive benefits if there's any children in the family that at that point are under age 16. So, for example, if a worker passes away and the spouse is only 50 years old, and there's maybe a 12 and a 14-year-old child in the family, then that surviving spouse would not be receiving a survivor benefit per se for themselves, but they're getting a benefit based on the fact that there's 2 children in the household under age 16. When those children reach 16, those benefits paid out for the children's benefit would stop. And also for any unmarried children, younger than age 18, those children are getting a benefit as well. So you might have a situation where the surviving spouse is getting a benefit based on the fact that there's younger children, and then the children themselves are getting a benefit themselves. There are some maximum amounts that a family can receive. That discussion is a little bit beyond the scope of our webinar today, but there are some family monthly maximum amounts that are received that kind of vary depending on what the worker's benefit was. So if what happens if you get remarried? Well, there's no survivor benefit if the surviving spouse remarries prior to age 60, but if you get remarried after age 60, then the benefits are not impacted at all, and remarriage does not affect the children that are receiving benefits that I just talked about a moment ago. So I'm going to spend a little bit of time here in the next couple slides talking about some rule changes that came into play, and those were back in 2016. So it's been a couple of years now, but I want to talk about them today because there's still a little bit of confusion surrounding these rule changes, and we are still getting questions about it. So I think it's important to spend a little bit of time on it. There were two very popular claiming strategies that were written a lot about and talked a lot about with clients by advisors, but some important rule changes came into play. And on November 2nd of 2015, a bipartisan budget act was signed into law, and the new regulations significantly change Social Security planning landscape for really millions of people. So these changes were very important, and the changes mainly affected two strategies that helped retirees increase their lifetime benefits. So the two strategies were known as file and suspend and a restricted application. So those benefit claiming strategies were key ways to kind of play within the rules of claiming, but allow two spouses to really kind of maximize their lifetime benefits. So I'm going to spend time first talking about file and suspend. It's a strategy in which one spouse, typically the higher earner, would file for their benefit, but immediately suspend their own benefits. And by filing, they trigger the availability of delayed retirement credits to accrue on their own benefit. But by filing, they were able to trigger the availability of the spousal benefit, and that allowed the spouse to start collecting benefits while their own benefit was suspended and could start to receive those delayed retirement credits. Now, you had to have been full retirement age in order to do this. So if someone filed and suspended by April 29th of 2016, then they were grandfathered in, and the old rules were still in play for that person. So they provided a little bit of a window after they put the law in place to say, okay, you have a few months to do this. You would have had to have been full retirement age to do it at that point. So there were some people who could do it. But if you file and suspend after April 30th, 2016, you can still do that, but the real leverage that was gained by doing that is lost, because all benefits are suspended when the worker suspends. So, as I mentioned a moment ago, the initial strategy was the higher earning spouse files and immediately suspends, so now they're not getting their own benefit, and their benefit can increase. But as I mentioned, it would have allowed the spouse to say, oh, okay, my spouse has filed, and now I can claim the spousal benefit. Well, now the new rule says, okay, if the worker suspends a benefit, all benefits that are based off of that worker are now suspended. So it really took the main benefit away from this, and file and suspend really isn't talked about anymore. Another feature that was within that file and suspend was a rule that impacted the ability to request a lump sum. So for those who were eligible to file and suspend before that April 29, 2016, they preserved the right to request a lump sum payment of their benefits during that suspension period. So, for example, let's assume that you were filed and suspended at age 66, so you could boost your benefit with the delayed retirement credits. If you decide 2 years later that you want to collect your benefits, maybe you were going to wait till age 70, but at 68 you say, well, you know what, I think I'm going to get my benefits. You can either start your monthly benefit at that time, and it would be 16% higher, because now remember you waited 2 years and 8% per year, so your benefit's 16% higher, or you could request a lump sum payment of the 2 years of benefits that hadn't been paid during that suspended period. And in the latter case, you would forfeit the delayed retirement credits and receive a lump sum payment. And the monthly payment that you would then get after that point would be equivalent to what it would have been had you had claimed at 66. So the new law prohibits that lump sum payment option. So for anyone who files and suspends after that date, April 30th, 2016, they will not have the choice to receive the lump sum. So going forward, not much reason to file and suspend, although the only real one reason to do it would be that you would be able to increase your own benefit if you had claimed early. So, for instance, if someone claimed their benefit at age 62, thereby receiving only 75% of their full retirement age benefit, they can still file and suspend when they reach full retirement age. So by suspending their benefit, they would stop receiving a monthly benefit, but would begin to accrue those delayed retirement credits that I mentioned for every year that they wait, and 8% will be added to the benefit. If they delay till age 70, the benefit would have increased by 32%, which when added to their reduced benefit would actually get them back to 99% of their full retirement age benefit. So in some cases, someone may want to do that to sort of get themselves back up to their full retirement age benefit to do that, but they would have had to have suspended their benefits and turned them back on at age 70. So we don't see that very often, and I think it's very rare that case would apply, but that's really the only reason why you would want to file and suspend at this point. You don't have the spousal benefit that you used to have. So the other rule change that I mentioned affected the restricted application. And this is a situation where a retiree files for spousal benefits only instead of claiming their own personal benefits. So this is a situation where someone's worked their whole life, they are eligible for their own benefit, but at their full retirement age, they say, you know what, my spouse is already collecting, I've reached my own full retirement age, I'm going to raise my hand and say, you know what, I just want my spousal benefit right now because I want my own benefit to kind of sit and accrue those delayed retirement credits, and maybe I'll wait till age 70 to turn my own benefit on. But I would have had these 4 years to take a spousal benefit off the table that otherwise would have just gone unclaimed. Well, so Social Security kind of caught on to what was going on here, and with the new rules, the restricted application has been changed. So it's not available at all to anyone that's born after January 2nd of 1954. So you must have turned 62 by January 1st of 2016 to be eligible to do this. Now, remember, you have to be full retirement age to do this. So even though you had to have turned 62 by January 1st, 2016, you'd have to wait till your full retirement age to be able to do this. So for those that are not eligible to do this, when they reach full retirement age, if they go to claim their benefit, the Social Security will see that, oh, okay, you're eligible for a spousal benefit or your own benefit. If you were born after that date, you're not able to just claim the spousal benefit. They're just going to automatically pay you the higher of the two benefits. You can't choose. They're just going to pay you either your own benefit or the spousal benefit, whichever one is higher. But if you were born prior to January 2nd, 1954, and you're eligible to do this, then you're fully grandfathered in, but you do have to wait till full retirement age. So eventually this rule will go away as some of the younger folks in that grandfather period start to sort of age out of that. But remember, people who have already filed and suspended or filed claims for restricted spousal benefits, the two rules that we just mentioned, they are grandfathered in and they will not be impacted. Otherwise, most folks are impacted by these new rules, and it's just important to sort of understand what they mean for you and any planning that you're doing around Social Security income. So let's move on to what it means if you're working while you're collecting benefits. So this rule comes into play for folks who decide to claim their benefit, but they keep working. So you're allowed to do that, but there are some rules that come into play here. So the rules have limits, dollar value limits, of the amount of earnings that you can have in a year while you're claiming your benefit, and earnings above that amount will start to impact the benefit you receive. So you can see on this table here, on the far right are the 2018 limits. So let's say that you are under your full retirement age and you claimed your benefit, but you're still working. You can earn up to $17,040 in that year, and your benefit won't be impacted at all. If you earn greater than that 2018 limit, so if you earn more than $17,040, $1 of your benefits will be withheld for every $2 in earnings above that limit. So, for example, let's say you're 62 years old and you're receiving your Social Security benefits, assuming you work and earn $27,040 in 2018, which, making it easy for myself, that's exactly $10,000 over the earning limit. So therefore, $5,000 will be deducted from your benefit. So $1 deduction for every $2,000 over the limit. So you were $10,000 over the limit, so $5,000 gets deducted from your Social Security benefit. Now, let's also assume that your benefit was $1,000 a month. Social Security will withhold your benefits for the first 5 months until they've fully withheld $5,000. Then they will resume your benefit payments for the remaining months of the year. So the rule changes a little bit for the year you reach your full retirement age. So for the months of the year before you reach your full retirement age, you can earn up to $45,360 in that year without having your benefits impacted at all. If you earn more than that prior to your full retirement age in that year, $1 of benefits is deducted for every $3 you earn above that $45,360. And then, of course, since we're talking about the year you reach full retirement age, once you reach full retirement age, the earnings cap does not apply, and you can earn any amount without having your benefits reduced. So let's say if you reach full retirement age in August, you can earn up to $45,360 in January through July without having any reduced benefits. And once your full retirement age is reached in August, in this example and beyond, there's no threshold. So you can earn any amount after that with no reduction in benefits. And the important point here is the only wages are considered for this, not other income, and the spouse's wages are not considered in this case. So they're not looking at total household income. They're only looking at the income earned by the individual who's claiming their benefit and still working. So what happens to those benefits that they hold back? Well, the withheld benefits are delayed, but they're not forfeited forever. So your benefits are actually recalculated at full retirement age, and then they are actually paid back to you. So any benefits withheld are eventually paid back to you. They're not forfeited forever. So to illustrate how this works, so let's assume you claim your benefit at age 62 and you continue to work and you've had benefits withheld because you've exceeded those earning limits. When you reach full retirement age, they will look at the total benefits that have been withheld, and let's say you've had the equivalent of 12 months of benefits withheld. That's a full year, so Social Security will recalculate your benefit as if you had first claimed at 63 rather than 62. So the net result is your penalty for claiming early is reduced and your benefit will increase. So it's a slightly confusing rule, but the takeaway here simply is to remember, if you do have benefits reduced, once you reach full retirement age, they're going to have a record of that, of what they withheld, and they just recalculate your benefit and they start to pay that money back to you. So there are a couple of rules here that are a little more obscure, but they impact folks who were getting pensions from work that they did that did not pay into the Social Security system. So one of them is this windfall elimination rule. So if you're covered by a pension under the civil retirement system and you also qualify for regular benefits from benefits you had or taxes that you paid into the system from other work, then your benefit could be reduced through this windfall rule or the WEP. So this rule can reduce the size of your benefit, but it cannot completely eliminate it. So for 2018, the maximum reduction that can be imposed when this WEP rule comes into play is $448 a month. So this rule is phased out for individuals who had substantial earnings and were paid into the Social Security system between 20 and 30 years. So if you had two different jobs, one where you were getting a civil retirement pension and one where you were paying into the Social Security system, if you were paying into the system for at least 20 years, then this rule starts to have less of an impact. And if you had 30 years of work into and you were paying SSA taxes, then you're not impacted at all by this rule. But as I said, for the maximum application of this rule, it can reduce your benefit up to $448 per month. And again, that only impacts an individual who was getting a civil retirement pension and that same person collecting their Social Security benefit. Now, another rule is the government pension offset, or the GPO. This is a situation if you're covered by a pension under the civil retirement system rather than Social Security, and your spouse or survivor benefits will be reduced through the government pension offset. So this is a situation where maybe you're getting your own benefits. Maybe you were a teacher and you're going to get your own benefit from a teacher's pension, but your spouse is collecting their regular Social Security benefit, and when you try to get a spousal benefit, then this is where the government pension offset can come into play. And the way that it works is spousal benefits and survivor benefits can be reduced by 2/3 of the amount of the pension that you're getting. So let's look at an example of how this works. So for instance, in the above scenario, the wife's pension from, again, let's just assume the wife was a teacher and their pension was going to be $1,500 a month. So the government pension offset, as I mentioned, reduces their Social Security spousal benefit or survivor benefits by 2/3. So 2/3 of the $1,500 is $1,000. So that government pension offset is established at $1,000. So you can see in the lower table, if the husband, in this case, had their benefit, and at age 66, the husband was set to receive $2,400 a month, the normal spousal benefits could be up to $1,200 a month, because remember we said spousal benefits could be up to 50%. So if that spouse could receive up to $1,200 a month, Well, here comes the government pension offset that we said in this example is $1,000. So the $1,200 is reduced to $200 a month. And the survivor benefit, instead of being the full $2,400 that the deceased was getting, that's also reduced by $1,000 a month. So that's down to $1,400 a month. And again, in the bottom part of that table, let's just say the worker waited till age 70 and they were receiving $3,168 a month, and that individual passed away. The surviving spouse who's affected by the government pension offset, again, would have that $1,000 reduction, and their benefit would go down to $2,168 per month. So those are a couple of important rules to be mindful of in situations where somebody might have a work and pensions that from that work where they were not paying into the Social Security system. So important to be mindful of that, and we spend some time around illustrating different scenarios of how those different rules can impact one's benefit and by extension one's financial plan related to all the moving parts of their retirement income. So a lot of times we work with our clients that they'll bring in their statement, and the statement contains a lot of information. So the SSA had some rule changes a few years ago where they put in place really, it was in order to try to save a little bit of money and improve the overall budget for the system. But they stopped mailing out statements to anyone who's younger than age 60. Surprisingly, I think the savings from that came out to about $9 or $10 million per year that they saved by not mailing out these statements. And frankly, that was probably a good thing to do, because I don't know what many 24-year-olds who were working and getting that statement. I'm not sure they did much with it. But anyway, for those over age 60, they still get that statement mailed to them. But of course, these days it's very easy to go online and get the same information on their website, which is simply ssa.gov. You can get all that same information from the website that you would from a statement. But some things to just keep in mind when you do look at the statement. It's assuming that when it lists, the Social Security statement will always list 3 bands of different projected monthly benefits. So they'll always show the age 62 benefit, which is the earliest, and then they'll show your full retirement age benefit, which for most people is age 66, and then they'll show the benefit at age 70. So, but important thing to note is that the assumption is that you're going to continue to work up until that age that they show. So the assumption by that statement is that you're going to have wages up until that age. So if you stop working and then wait to collect benefits, it could be different than what you see on the statement. And it also assumes that you continue earning the same amount from the time that statement was generated up until that particular age where they show you benefits. So naturally, if you're receiving increases in your wages, then that's going to make those benefits actually come in higher than what you see on the statement. So earning more or less in the future could increase or decrease what the benefit estimate would be. Couple more things to be mindful of on the statement. All the estimates are shown in today's dollars, and as I mentioned a little while ago, benefits are subject to normal cost of living increases based on the regular inflation. So sometimes benefits aren't increased at all, and sometimes they may receive a small benefit increase, 1%, 2%. So benefits you see on your statement are in today's dollars. So if they show a benefit at age 66 and you're age 60, by the time you get to 66, your benefit might actually be higher. So it's important to always have the most recent statement before running any scenarios or looking at your benefits within the financial plan. But I do like the idea of looking at the benefit statement because it is going to have a record of your earnings history. So we'd like to have people review that because that gives you a good idea of, oh, do I have 35 years of work that's going to be calculated in? Or someone might look at that and say, oh, geez, I only have 30 years of work history. So any amount of money I earn beyond this point, then even if it's part-time work, then that's going to knock off a year that was a zero and add some earnings in there to help your overall calculation. So that it's important to be aware of all the moving parts of the statement for that reason. So a lot of planning considerations around these benefits. So even after the new rules that I talked about, I'm calling them new rules. They're a couple of years old now, but we still sort of refer to them as the new rules because of how big of an impact they had on the planning landscape. But there are still many different claiming scenarios to consider around regular workers' benefits and spousal benefits, and of course the timing of when you claim your benefits is going to matter, and whether you're still working or not. So this whole idea of claiming at 62, the earliest that you can, it doesn't mean that you should, even though you can. So in situations where one reaches age 62, sometimes it's like, hey, you know what? I heard that the system's going broke. As soon as I'm able to claim my benefit, I'm gonna take it because I'm worried about losing it. Well, that's really not the case. I think anyone who's of retirement age right now doesn't have anything to worry about with their benefits. There's over $2.5 trillion in the trust fund to pay out these benefits. So many people who are at that age now won't really see an impact. Younger people might, but it's important to consider, well, should I wait beyond age 62? Will that help my overall financial plan if I do that? And really, there's no one rule that we could say here on our call today to say, well, always do this, always wait till this age, or always wait till that age, or always have a spouse claim at this point. It's really no one size fits all. So we have to kind of look at your overall financial picture. And with that same thought, the recommendation is really to look at your benefits within your entire financial plan. There are some nice tools out there to look at just these benefits in and of themselves, but important to kind of look at them within your financial plan. Do you have pension income that comes into play, or are these benefits your only guaranteed source of income? Well, in that case, we want to try to maximize those benefits and have them work well for you. And really, what we like to do is look at multiple scenarios to see what makes the most sense. We have tools here that we use at Stonehearth that can show you side by side, well, what if I claimed at 62 versus 66, or what if I claimed at 66, but my spouse went ahead and claimed early, even though they were penalized? Is that still okay? Well, maybe that still works in certain cases. So really important to kind of just look at these claiming scenarios within your own financial plan and kind of jump back and forth of, all right, scenario A versus B, and see where do I get my most impact down the road overall in my financial plan. So we've covered a lot of ground today. I could probably go on and on talking on this topic. There is a lot to cover, but I think we really covered all the important points here today, and certainly can go into depth in any of these points. So at this point, I'll turn it over to Amanda, see if there's any questions from the audience today.
Hi, David. Thank you so much. That was a lot of information. I just want to remind everyone to use the questions box if you do have a question. And if we have time, it looks like we're running a little bit short, so we'll answer a couple here. The first one, David, is if my spouse has collected their own benefit early, but I wait until my own full retirement age to claim a spousal benefit, do I receive 50% of their reduced benefit?
Yeah, that's a good question. So early on, we talked about that scenario. So if the spouse waits to their own full retirement age, they're not going to receive 50% of that worker's reduced benefit. They're going to receive 50% of that worker's full retirement age benefit, even though the worker is not actually receiving that. So the spouse, if they wait to their own full retirement age, they're going to get 50% of that worker's full retirement age benefit.
The next one I have is if I wait to collect a survivor's benefit after my full retirement age, will the benefit increase?
Yeah, well, the survivor benefit is not eligible for those delayed retirement credits. So if the surviving spouse waits till after their full retirement age, it's not going to help that survivor benefit. But of course, if the deceased spouse had waited to claim their own benefit and got the delayed retirement credits, then that's going to help what the surviving spouse can increase. But the survivor benefit does not get those 8% per year bump ups.
And just in respect for time, we'll do one more here. It says, I read something about a break-even point when analyzing what age to collect benefits. Can you explain what that means?
Yeah, the concept of the break-even point is talked about a lot in articles related to this topic. And really what that means is in cases where you receive your benefit at 62, like I said, you'd be reduced by what you would have got at 66. So your benefit's reduced, but you're also collecting benefits 4 years early. So the break-even point just refers to a point in time in one's life where whether you collect it at 62 or 66, you're going to eventually reach the point where you would have, on a dollar value basis, you would have collected the same amount of benefit. And what we find is that break-even point comparing age 62 and 66 is at about age 76. So at age 76, whether you claimed at 62 or 66, at that point you would have claimed about the same amount of benefit. So the idea is, well, if I think I'm going to live beyond that break-even point, if I wait and get a higher benefit, then I'm going to end up with more benefits over my lifetime. So that's what that means. But we look at that when we talk to clients about break-even points. It is an important topic.
Thank you so much, David, for all of the information that we received today. I just want to remind everyone this is our May webinar. We do have one webinar every single month for the rest of the year. The next one is stress testing the risk within your portfolio. That'll be with our Chief Investment Officer, Chris. That's June 26th at 2. And then for July, it'll also be with Chris. It'll be his quarterly CIO's Corner update, which will be July 20th at 11. And you can find those on our website at www.stonehearthcapital.com if you'd like to register or see the rest of the webinar calendar for this year. So thank you so much, David, and we hope that everyone has a wonderful day.
Thank you. Take care, everybody.